Test, test. Can you hear me? Test. Gotta be louder. Test. Can you hear me now? Can you hear me? Does it matter how loud I go? Good. Okay.
I don't think anybody will come. You're sounding good. Are you gonna stay kind of in this general area?
Yeah, I will. I'll need to. I'm just trying to think if I ask maybe at the end or something, or like the next classes to, because we have a lot of probably in retirement versus
What's that?
people are planning ours.
If
Do you want that?
if people ask questions online, I'll just raise my hand. I'll try and do that.
Yeah, and maybe what I'll say at the beginning of, you can put questions online in the comments, and then Mike's discretion will
Just say we'll try and answer.
we'll
questions online.
answer them online, or we'll have time at the end if it makes sense
Yeah.
to do it at the end.
And I'll try and watch comments. I don't. Right now, it's not showing me comments, so I gotta work on that. So maybe
Yeah.
just don't even say anything for this first one.
Well, if they, yeah.
We'll try, or we'll respond to comments afterwards.
Yeah. It's on YouTube Live.
YouTube Live?
Yep. And then shortly after, it will be there as a recording.
So I can tell my husband to go on to YouTube Live?
And our channel, like, I haven't found it's Ignite_financial, but the best way I found is on the Facebook posting, just clicking on it, because there's a lot of Ignite financials I found out there that if you just Google it, it's not the best.
So on Facebook, on
It's on Finheads is probably the best, easiest way to go. It's on my mind, but Finheads is a good one.
I think that's where I found it.
And that just clicking on that link is probably the best bet to get to it.
Just Finheads, okay?
And then it would have been posted last week, I think it was. Hi. You okay, Mike? You okay in about 30 seconds then? You okay to start right at 5:30 then? Okay. Hi. Okay, it's 5:30. Out of respect of your time, we'll go ahead and get started. Welcome to tax planning before and during retirement. So this course is going to be about how to pay the least amount of taxes over your lifetime. Okay? We're going to start with a story. It was working before. So this, thank you. This is recorded on YouTube Live, and there'll be a recording on there shortly afterwards that you can view it then at your own pleasure as well. And people are watching it live. You can add comments. We'll do our best to answer those as we go. Otherwise, we'll look at them afterwards. So to start with the story, we have Bob and Sue coordinated and Bob and Sue uncoordinated. They are the same age. They're both age 62. They have the same savings, same portfolio, same investments, and they have the same lifestyle. $100,000 spending per year is what they decided on. But their decisions are drastically different. So the uncoordinated Bob and Sue decide to take everything from their traditional IRA account. Whereas the coordinated Bob and Sue ask one question: where should we take the $100,000 from? So uncoordinated, they just take it all from their IRA. It's simple to them. It feels logical. It makes sense. Versus, where should I take my $100,000 from? They look at their taxable brokerage account. How much is there? How much is in capital gains? They look at their traditional IRA account. How much is there? They look at their Roth account. So looking at all their accounts before they make a decision on where it's going to come from. They do a rough projection of their 5-year cash flow. Yeah, it's not going to be perfect, but we can do a rough. They look at what their projected RMDs are going to be. So they're asking these little questions that allow them to be a little bit more intentional about where they're going to withdraw money from. And what that leads to is a widely different tax outcome. Over $8,500 just in 1 year, because they were a little bit more intentional by what they did. Now, that's not saying what they did was right or wrong, but they paid $0 versus the uncoordinated paid over $8,500. Because to get to $100,000 net, they need to withdraw over $108,000. Where the coordinated Bob and Sue knew what the standard deduction was, filled that up with some IRA money, and then took the rest from brokerage. Some of that was basis, meaning they've already paid gains on it, and some of it was gain, and some of it was capital gains, and they fell within the 0% tax bracket. And if I lost some of you, that's okay. That's what this course is going to be about. We're going to go through the fundamentals here in class number 1. But the moral of that story, the takeaway of the story is, it depends on when and where your income comes from. So where they pulled the money from, they're different buckets. They all have different tax treatment. and then when we pull it, because it stacks differently, which we'll talk about. So who I am, my name is Casey Redmond, fee-only financial planner here in Cedar Falls with Ignite Financial. I started just as many of you did in your seats, learning from Mike Finley. So I'm excited to be on this side. It's been probably maybe a year or two since I've done a class. So I'm excited to be back here, and hopefully the goal today is that you walk away a little bit more confident after each class with your tax planning situation. So our course roadmap tonight is going to be learning more of the fundamentals of how taxes work. And then next week, class 2 is going to be how do we go about paying those taxes? When does it make sense to pay now? When does it make sense to defer taxes? In 2 weeks, session 3 is going to be more tools. So we're going to dive into Roth conversions, asset location, tax harvesting, how to access money pre-59.5 for those that is a desire. And while I think I meant to mention this at the beginning, in 2 weeks on the 17th, we don't get access to the room until 5:30 for those that are coming here. Otherwise, it's 5 o'clock the rest of the nights. So 5:30 in 2 weeks at the 17th, it was booked beforehand. And then session 4 is going to be about putting it all together. So how do we go about creating that paycheck at different ages? So there's different windows of opportunity that we're going to be talking about and when it makes sense to turn on different types of income. So we pull those different levers. So the goal is for you to understand the core principles. The more you understand the core principles, the better off you're going to be able to discern how to apply those and how to act for your specific situation. Because you don't need to be an expert with the whole 1,000-page tax code. You need to be an expert in your situation and not somebody else's. And you don't have to memorize the principles that we're going to talk about. You have to know they exist and how to use them. And then making sure every decision aligns with your goals. Because as with many things, there's the financial, there's the math behind it, but then there's the non-financial. How does that align with your goals and what you want the money for? So you don't need to be an expert, but you do need to understand some core language, some concepts. Many of you have learned from Mike Finley investing, right? There's an investing language. There's a tax language as well. Just like you've learned different languages throughout your life, through your job and through personal means, it's learning this language slowly as you build upon those and apply them to your situation. And then, just as anything, committing to continuous learning and improvement. Because when the tax laws change, the most recent one Big Beautiful Bill Act, how does that apply to your situation? When your goals change, how does that adjust things? When your portfolio does better than maybe you thought it would, does that change any type of goal that you might have had? And this can be related to, you don't need to be a surgeon to know that eating, moving, sleeping is good for you, right? It's knowing those fundamentals and doing those fundamentals. Similar to investing, you don't need to know every single stock in the Vanguard Total Stock Market Index, but we need to know that low-cost index investing beats active investing. So it's what are the core concepts of tax planning is what we're going to learn here. So today's objectives: taxes follow a formula, understand income stacks, different types of income matter, and buckets matter. Each bucket has a different tax treatment. And as we saw in the beginning example, the same savings doesn't necessarily mean the same tax outcome. So to begin, tax prep versus tax planning. How we like to look at it is tax prep, you look it in the rearview mirror. Some of you have already filed your taxes. Some of you are getting your stuff together to file. All that stuff happened in 2025 though. There's no shaping that. There's no controlling that. It's already happened. Versus tax planning, I'm looking through the windshield. I'm planning You know, quarter one here, I'm planning what's going to happen the rest of the year. Where does it make sense for me to withdraw my money if I'm in retirement? Where does it make sense for me to save my money if I'm still working? And how those decisions that we make this year not only impact the end of the year for next year's tax, but also the years thereafter. You know, as we're saving, that's going to impact when we draw money years down the road. We're going to talk about the federal income tax formula. We're going to do a simplified version and then briefly show you the more complex version, so you know that there is a full version out there. This isn't about for you to memorize, okay? But we need to know that it exists and how to apply it for our situation. First, why it matters. The formula matters because we have adjusted gross income, we have modified adjusted gross income. And these affect different things. You know, if we're in or near Medicare age, it could affect premium surcharges. If we want health insurance pre-Medicare through the Affordable Care Act and Marketplace, those two, IRMA and Affordable Care Act, are looking at modified adjusted gross income. But they look at different parts. You know, for example, your non-taxable Social Security is included in the Affordable Care Act premium tax credits. It is not included in IRMA. And the net investment income tax has its own modified adjusted gross income. So there's a little bit of nuance to some of this stuff, but a big driver is your taxable income matters as well. That's going to drive a lot of your taxes. And you have more control over that than you think. We saw in the beginning example, over $8,500 difference in 1 year. Compound that year after year after year. So here's a simplified version. We're going to take all our income, all your household income, add all that up, whether that's from interest and dividends, whether that's from working income, from pension, Social Security, IRA pre-tax money. We're going to add all that up. Then, for most of us, we're taking the standard deduction. For a married couple filing jointly, that's $32,200 this year. Cut that in half for single. And if you're 65 plus, add another $15,300 if you're married. That's going to get to your taxable income. Once we get to our taxable income, then we apply the tax rates. There's the ordinary income rates that a lot of us are familiar with. That's the 10%, 12%, 22%, so forth. And then there's the capital gains rates, 0%, 15%, and 20%. And for the select few, there's a couple more percent added on. But most of us are going to be in that 0 and 15% range for capital gain rates. So after you get to your taxable income, you split up what's ordinary income and what's capital gain income. And we'll go through examples of that. So then you get to your taxes owed. So that's a simplified version. The more in-depth version, so what we didn't show is there's adjustments before the standard deduction. For example, if you're self-employed, there's certain adjustments. If you're contributing to a health savings account through your payroll, there's an adjustment. Traditional IRA contribution is an adjustment. And then credits get added at the end, are kind of the two big ones. But for a lot of us, if we just get that gross income, standard deduction equals our taxable income times tax rate equals tax owed, you know, if we can do that back of the hand napkin math, that's going to serve us pretty well. And then knowing how, that this is out there, and then how I apply it. So another way to kind of look at this, we have the adjusted gross income. And you're going to find out, I'm going to intentionally repeat myself so it sinks in different ways, right? So we have the total income after adjustments is when we get to our AGI. I get those adjustments if you're self-employed, you contribute to an HSA, you contribute through your payroll. If you contribute to an HSA outside of your payroll, it's different. And what this is going to drive is IRMA, the Medicare, Social Security taxation, Affordable Care Act. So these are about kind of the phase outs and the credits and the cliffs. You know, if you go over $1 on the Affordable Care Act, which is 400% poverty, nothing, right? If you go over $1 on IRMAA, you're paying that extra. So it's kind of that timing of the income, where your taxable income is your adjusted gross income minus those, basically the standard deduction for a lot of us, which is going to determine your marginal tax bracket and your capital gains bracket. That 0% capital gains bracket is within the 12% marginal bracket and below, and I'll say that multiple times. So AGI affects eligibility. The taxable income determines how much tax you're actually going to pay, what tax is owed. And why aging and time matter. You know, I kind of went over those standard deductions. The One Big Beautiful Bill Act was the latest one that helped people 65 and older. And we're going to go over more, I believe it's next week, on all the different tax laws and how they really favor the older versus the workers. So $15,300 for a married couple, because you have $6,000 per person for the One Big Beautiful Act standard deduction, and then you have the original standard deduction. And that just it could be the same income somebody has at 65 and 64, but widely different taxes because of that additional deduction. So that's one of the windows, right, on when we pull income and where and why, that we'll be going through examples. So the income limits, for those that are not aware of this, One Big Beautiful Bill Act, $6,000 per person. And if you go over these thresholds, it's not like it's not a cliff that it just goes away. It's basically a 6% rate, and then it goes away at $175 for single and $250 for joint. So it's not that you lose it entirely, like you just lose a little bit, little by little. So let's take just an IRA example. No other taxable money, no other Roth money in there. We have David and Karen. They're age 60, recently retired. They know that they've decided they want to take $145,000 withdrawal. They're not really sure what tax they're going to have to take. They don't know how much they're going to have to withhold. So let's walk through this. First, we have the standard deduction. So we're going to pay nothing right away on the first $32,200, and it would be more if you were 65 plus. Then we get to the 10%. Then we get to the 12%. And then finally the last dollars hit the 22%, but only those last dollars. So we're in the marginal bracket of 22%, but our effective, our average tax is below 10% because we're climbing those steps. Some are taxed at 10, some is 12, and only a little bit at 22. So then you can do your math and how much do I need to withhold per paycheck I take, or maybe I just withhold it all at the end. Because in retirement, you don't have to withhold it all like when you're working, every paycheck. You can do it all at the end of the year if you want. Marginal versus effective. So marginal is taxed on your last dollar. So if I cross that 22% threshold just by $1, I'm still in the 22% bracket. Versus effective, I'm adding all that up, and I'm taking it by my total income. So in this example, their tax was over $14,000, and they're dividing that by their total income to get to that effective rate. So many of us, whether we're working and we have kids, or we're doing, pre-tax contributions, or we're retired and we're playing with our income, where we take it, which bucket we take it from, we might be in a certain marginal bracket, but most of the time our effective is going to be much lower because of credits and deductions. So again, not all income is taxed the same, and not all dollars are taxed equally, because we have different tax treatment and we have different ways they're stacked. So character counts here. We have W-2 ordinary income. Again, this is the same category as the pensions, the Social Security, the traditional IRA money, outside of your working money. And then we have interest and non-qualified dividends. So think of your savings, your checking account, your taxable brokerage account. Both of those are in the marginal bracket. Then we have the qualified dividends and capital gains, also known as preferential income, because it gets a different, more favorable rate. The marginal rate for those first two is 10, 12, 22, 24, all the way up to 37. The capital gains rate is 0, 15, 20. And we have income that stacks. So ordinary income comes first. So when we get to that taxable income, when we talk about the formula, we have ordinary income that comes first, and the capital gains get stacked on top of that, the long-term capital gains. Short-term capital gains, which is when you hold an investment for 1 year or less, is at ordinary income. Long-term capital gains, when you hold an investment for over a year, is at the capital gains rate. So that's an important distinction when you're trying to figure out, am I in the 0% or the 15%, or what portion of my capital gains is in the 0%, because as soon as I cross over into the 22% marginal, I'm going to be in the 15% capital gains bracket. And some people do that, just unintentionally. Well, I can take another 20,000 and didn't realize the hit they were going to take tax-wise until they get their return. Because really, this is about, we don't want to be surprised when we file our return. The more we know in taxes, the more we plan for them, the less we should be surprised, the more we should do if we want to break even, if we want to owe a little bit, and not get that big refund. So let's take a working couple income example to kind of illustrate this. We have Mark and Sally, age 45. They have ordinary income of the household of $200,000 from their W-2 plus some interest income from checking and savings accounts. Then they have qualified dividend income of $5,000. They also invest 20%. They invest some in a pre-tax 401k and some in an HSA. So that's going to reduce both adjusted gross income and their taxable income. So their adjusted gross income after they reduce those savings of $40,000 is $165,000. And then from there you take the standard deduction away to get to your taxable income. And then you apply the tax rates. And the last $5,000 is the capital gains. And that's going to be they're in the 22% marginal, so they're going to be a 15% capital gains rate. So their federal tax in this example is $18,000. After they apply the 10%, 12%, 22%, and the capital gains rate. Let's take a retired couple example. And this is going to be Mark and Sally, just older. They're age 62. They want to spend $100,000 in retirement. $50,000 comes from their traditional IRA account. They have $5,000 in interest and non-qualified dividends, so that's all their ordinary income, $55,000. And they have $30,000 in long-term capital gains from selling $50,000 in appreciated stock. So we know $20,000 of that then was basis. They've already paid tax on it. Their total adjusted gross income is $85,000, even though they generated $105,000. That falls in the standard deduction, the 10%. Their taxable income is $52,800. And that 30,000 of long-term capital gains is taxed last. But because they're in the 0% capital gains bracket, they don't owe any tax when they sold that 50,000. And they owe a federal tax bill of 2,000. And in both cases, they both netted pretty close to a little over 100,000. The working couple had $18,000 in tax. The retired couple had 2,000. And that's where different types of income and your age can matter. You know, we're a little bit more hampered in our working years because we can have a nice income, but we need to be able to live off of that depending on where our lifestyle is, versus when I'm retired, I only need to pull what I want to spend. And I can have different types of income that some aren't taxed, because $50,000 of this wasn't taxed, right? Because some of it they've already paid tax on the brokerage, and then 30,000 of the gains fell in the 0% bracket. So same spending, widely different tax outcome. And a key point here is they have over $40,000 left in the capital gains bracket. So they could do nothing with that. They could decide to sell some and then reinvest it and just reset their basis. So then when they want to sell some later, they don't have to worry about owing as much tax if they happen to fall in the 15% capital gains bracket. So taking advantage of that window in that year, even if they weren't going to spend it all. So we hinted at some buckets. Yeah. Black Sonata with Illinois plates.
Thank you.
No problem. So we have the three retirement tax buckets. We have the taxable brokerage account, where it's already taxed when you put it in, and then you're getting taxed on the non-qualified dividends, the interest, and then when you pull it out, you're getting taxed on the gains. And this could be your bank, your account, CDs, checking, savings, joint brokerage account. We have our tax deferred, which is pre-tax. So this could be a traditional IRA, the traditional 401k, 403b, all those pre-tax accounts. That money is going in tax-free. I'm not paying tax on it today. It's going to grow tax-free. And then when I take it out, I'm potentially going to pay tax. Some of that might be sheltered by the standard deduction, as we've seen. And for all that you're pulling money now, when you never paid state tax when you put it in, and you're not paying state tax when you take it out. So some of this money is kind of looked at as Roth money because you never paid tax on it, right? And then we have tax-free, your Roth IRA, your Roth 401k, your health savings account, 529 accounts, and all these with the asterisks for qualified withdrawals qualify for tax-free. And then the tax planning piece, as we've seen with a couple of examples, is stating when and how we use these. So using them with purpose, using them with intention. And these buckets, so, you know, Finley does a lot about investments. This class not about investments. So investments is about asset allocation, how much I have in bonds and stocks, versus when we're talking about these buckets, we're talking about tax treatment. So when we talk about asset location in a future class here, which it matters that certain investments have a better tax treatment depending on which bucket we're talking about, but your overall asset allocation doesn't change that. I could be a 70% stocks and 30% bonds and cash, and then I place those assets in the appropriate bucket depending on their tax treatment. So bucket mix is going to determine a lot of your options. What flexibility do you have? You know, somebody who has one bucket, if I take that beginning example of 1.5 million, one person has it all in a traditional IRA, Another one has it all in a brokerage. Another one has it all in a Roth IRA. That's not all the same money because of the tax treatment. And then they don't have as many options. And that's not saying right or wrong. We just have to look at what is our current situation and how we make the best of it. Because all that controls your tax outcome this year and the years thereafter. So taxable accounts, we're going to dive into this a little bit so we know a little bit more about how the capital gains and losses are applied. So again, capital gain rates, long-term capital gain rates have preferential treatment. Short-term gains get included in the ordinary income. You can control your gains and losses with this versus you don't have as much control inside your retirement accounts. You receive a step up at basis at death, so your beneficiaries, all those gains get stepped up at death. And there's no contribution limits as there is with retirement accounts. So to determine the capital gains and losses, if you sell an investment, first, you're offsetting by holding period. So if I have a mixture of long-term capital gains and losses and short-term capital gains and losses, I offset by holding period first. So long-term gains offset long-term losses, short-term gains set off short-term losses. That's step one. And then step two is I'm going across holding period. So if I had losses exceeded my gains, then if I had a short-term loss, those are going to offset a long-term gain. I'll go through an example here in the next slide. And those can offset income and carryover. And they can carry over from year to year. So here's an example. Somebody had a short-term gain of $10,000. They had a short-term loss of $7,000. So we set across holding period first. So they had a net $3,000 gain. A long-term gain of $15,000 and a long-term loss of $20,000. So that's step one. They have a $5,000 net long-term loss and a $3,000 net short-term gain. Now we have to offset those two. So we have a $2,000 net capital loss for step two. That loss can offset other income, ordinary income, for example, up to $3,000 per year. And then that can get carried over. If I had $10,000 in losses, I would use $3,000 this year, the next $7,000 would carry over, and I'd use $3,000 next year until it's all gone. No, this is personal user error. I don't like bright screens at night. Yep. Here we go. Thank you for that, though. I'm generally not on my computer, but if I am, I don't like the blue light. Thank you. So we have a carry forward that carries indefinitely until all those are gone. Now, key point here is if you are preparing your own, or if you're handing it off to a preparer, making sure it's noted properly on your taxes. You know, it just doesn't happen automatically. We need to do our due diligence there as well. Yeah.
So, I know over the course of the long term, buying and selling mutual fund stocks, there's probably nobody in here like jotting down what the gains are. You know, your long term versus short term capital gains. Does that all come to you when you sell?
So when you get your 1099 consolidated, like people would have got it here at the end of January, sometimes February, it's going to be noted on there based upon what you sold, what those gains and losses are, whether they were short-term or long-term. And then that's going to be for that year. So if there was, I need to make sure I input it correctly if I'm doing my own and then carry that forward. And if you're doing TurboTax and stuff like that, they're going to they should carry that forward, but you still want to make sure that it's noted there. So, so it's going to be a little bit different than a mutual fund. So if you get $250,000, that's free. You don't have to worry about. And that's per person. So if it was a couple, it would be 500. So let's look at a planned capital gain sale. Adam and Kate, couple, age 55. They're still working. As a household, they have $110,000 of income. They plan to sell $80,000 of appreciated stock. What happens when they sell? So we have ordinary income first of $110,000. The capital gain, remember, gets stacked on top of the ordinary income when we're applying the rates. What options could they have considered? They planned on selling $80,000 of appreciated stock. They have $110,000 of income. Do they sell it all this year? Could they have spread it out over some years if it was a planned? They would be at the 12 before. It goes up to the 22 and the 15% capital gains rate. Yep, figure out where that ceiling is what she said, and take out enough where they are in the 0% capital gains rate. They could also, if they kind of knew about this ahead of time, do they spread it across years? So they sell half this year, half next year. Depending on their lifestyle, what were they doing pre-tax contribution-wise? Do they increase pre-tax contributions to lower their ordinary income? So when their capital gain income gets stacked on top, and then all this may or not be possible, but it's questions to ask before of just unintentionally, well, let's just sell this and then we'll worry about the tax consequence later. Because it can amount to several $1,000s that maybe could have been avoided with a little bit of planning. So let's look at an unexpected expense, because this happens in life, right? Things don't just go in a straight line. We have twists and turns. We have ups and downs. We don't know when things are going to happen. Mark and Sally, age 62, retired. Another $100,000 spend example. They are currently taking everything from their IRA account. They have a life event. It doesn't really matter what it is. It costs $50,000. And they need to know how to fund it. What do they do? We can go back to their buckets. What options do they have available? So they're taking $100,000 in year one from their IRA. In year two, an unexpected event happens. They were planning on doing $100,000 from their IRA. This event happens throughout the year. They need an extra $50,000. Where could they take it from? What's a consequence for each decision? So if they pull it out of the Roth, everything is tax-free. Yes. So the answer was if they pulled everything out of their Roth account, the $50,000, it's all tax-free. So what's the downside of that? If we look at the other side of the coin. Future gains we could have made out of that $50,000 over the next 20 or 30 years. We haven't filled up our 12% bracket. RMDs coming up in the future years. We want to look at how much do we pull more from the IRA. Capital gains. What's our capital gains in our taxable brokerage account? Are we able to take enough to fill up the 0% capital gains rate? So maybe they take some from their traditional IRA and some from their taxable. Because our taxable account, even if you have tax efficient investments, which we'll talk about what those are still going to kick off some dividends. So how the tax code reacts is if they take it all from their IRA account, they're going to be pushing the 22%. Okay? And if they're doing asset location, they're going to have close to 50% of their IRA money in bonds, potentially. 40, 50%, depending on what their asset allocation is. So I'm not going to tell you right, wrong, or answer there because it also depends on what their goals are, right? There's a lot of factors there as well. Yes? They have kids, they want to have inheritance. It's another great point. You know, what is the money for is a question that we love to come back to because that changes. And it's always, when we first hear that question, when we ask that question, it's like, it's a good question. Because many of us haven't been trained to think that way. Yeah.
Maybe if they have that much free tax, they want to spend that free tax.
Yeah.
Somebody could be in ill health, you could wonder if it could be the widow's tax. Somebody can get stuck with that big IRA if somebody passes away.
Yep. Some people just want to take everything from the IRA, regardless maybe necessarily of the tax consequence that year because of other extenuating circumstances, whether it's health or just I just want to get some of these taxes done with. Yes?
Somebody online asked if you could do a backdoor Roth.
Do backdoor Roth, yeah. Another option.
Don't they have to have income?
Yeah, I guess that's getting a little bit deeper into the story of did they have any part-time income? Yeah.
Could you define a backdoor Roth?
So backdoor Roth is if I'm over an income limit, I have earned income from a job, not earned income from pension, Social Security, traditional IRA, but I'm not able to contribute to a Roth IRA because of my income. So I contribute money to a traditional IRA, let it sit there usually a day, maybe two, and then basically do a conversion and move it to my Roth. Good point. It's not. And they don't have earned income, they're not going to be able to do that. Yes. Yep. That's just basically the backdoor Roth is a way for somebody higher income, not eligible to contribute regularly. So that's my way out of there. And there's a caveat there. If you have traditional IRA money already in there, there's a lot more nuance I'm not going to get into now, but if you want to do a backdoor Roth IRA and you already have traditional IRA money, it gets more complex. So the lesson there is taxes aren't even. They're progressive as we talked about, and then where and when can affect that lifetime tax and depending on what our goals are. Here's an unusual example that is a little bit counterintuitive. When higher taxable income, because we always think of when we hear income, higher income, we think of usually more taxes. So this is a higher taxable income but lower taxes. So Mark and Sally, 67, they have lower taxable income, but they're ultimately going to pay more in taxes. Now, they don't pay a lot in taxes because fortunately they're over 65 and they have $47,500 in deductions, but they're still going to pay over $3,500 in taxes. And this goes back to the character of income, where they took it from and how it stacks. Bob and Sue, they pay $0 in taxes. They're the same age, same deductions, but notice where they took their income from. They have $32,000 of ordinary income from IRA and interest. So that is all sheltered by the standard deduction. And then even some of their long-term capital gains is sheltered by the standard deduction. And it's all within the 10 to 12% marginal bracket. So over a $50,000 difference in taxable income, but several $1,000s difference in taxes due, taxes owed. And that doesn't mean they have to spend it all, right? They could reinvest some of those in the brokerage account of what they gained. Traditional, yes. Yes. Probably should have put traditional there, yeah. Yeah, so they both took from a traditional IRA pre-tax, yes.
How big is that pre-tax IRA?
Yeah, and that could be basically for every. The question was, is this another example if you don't really know what's right or wrong? And that's for a lot of these, right? The one thing about this we talked about at the beginning, you don't have to be a tax expert, and you're also not going to have the perfect answer unless you're looking in the rearview mirror. You can plan, and we can save thousands in taxes, but we don't know certain things because some things are non-financial, and until we get in the weeds on a lot of these, you're not going to know that answer just from a little bit of snapshot.
I think you touched on this already. So the big difference is the standard deduction and the long-term tax. So $100,000 a month, you're not generating any income or any taxable income on that because they're pulling some of their standard deduction off of the money that they made from their long-term capital gains. And then they're also not breaking into the tax bracket on that. Is that what you're saying?
Yep, so we have the ordinary income that is sheltered by some of that standard deduction. Oh, yes. So the question was, how are they basically paying $0 in taxes when they're generating $100,000 in long-term capital gains? So the $32,000 of ordinary income is sheltered by that $47,500. And then we have $15,000 of the long-term capital gains that is sheltered by the standard deduction. Then the rest is going to be sheltered within the 0% capital gains brackets. You can have, I think it's 98,000, I think it is for a couple. Yes, and yeah, don't quote me on that, but it's inflated just like the 10%, 12% brackets are inflated each year as well. Not your age. Just the standard deduction would be affected by your age. So as we go about wrapping session 1 up here, before versus during retirement. So majority of your bucket mix is built during your working years. And as our income drops, whether it's for a period of time because we're in between jobs or staying at home, that's when flexibility happens, or when we are retired, and those windows start to open. So the planning starts shifting from building that money to coordinating where that comes from, depending on how our goals and our life unfolds. And as we talked about tonight, we're trying to pay the least amount of tax. We're trying to avoid tax. Tax avoidance is not illegal. Tax evasion is illegal. So I don't think more of us want to pay more in tax, but And this is going to be a visual of kind of the same thing here. In both situations here, whether you're working or you're retired, you both have income and you both have choices. When that income gets turned on, where do I save? Do I save in Roth? Do I save in traditional? Do I save in taxable? How much do I do in each? Where are my goals? When do I want to start accessing that money? How can I access that money? To create that flexibility for when I do start withdrawing, that I have options. Because you can try to, especially when you're in your working years, you can try to perfect it as much as you can, but as we know, we're not going to have it perfect because we don't know what the future is going to unfold, both in tax laws and our life. And then during retirement, again, you're trying to coordinate that income. And you have to pay the tax. You know, it's not coming out of your paycheck. You have to pay it out of your IRA. You have to pay maybe estimated taxes. You have to pay it in some way, shape, or form. And you have to manage that on a yearly basis at least. And maybe as the year goes on, depending on your situation. And then we all have the same goal, controlling when and how we pay taxes. So here's just a little bit of a framework. So we're building and managing that bucket structure, the different tax treatments, right? We're not talking about asset allocation. We're building those buckets in terms of tax treatments to help create that optionality in using those tax windows. You have tax windows when you're working, when you have higher income, when you have lower income, when you have kids, when you don't have kids. You have tax windows when you're getting near retirement, when you're in retirement before you turn on Social Security, or if you have a pension, before RMDs start kicking in, before Medicare happens. There's different tax windows that you can utilize. And then you're building and managing that income as you go along by what do you turn on, what do you turn off, what do you pause. And then you're continuing to adjust. So I'm sure many of you are like, well, what is my current bucket mix? That's something, if you don't know, figure that out. What is that in dollar terms? What's that in percentage? And it's just something to realize. It's not something to beat yourself up or shame. It just, this is my situation. Now, how can I apply it to the best I can to fund the life that I want to live? So just a recap of what we learned. Taxes follow a formula. The simplified formula, there you go. The simplified formula is the income, the standard deduction to get to our taxable income. Then we apply the tax rates. We split ordinary income and capital gains rates. You have the 0% capital gains rates if you're in the 12% marginal or below, and then you bump up into the 15% thereafter. You don't get to the 20% until you're way high in the marginal bracket. And we learned that same savings don't equal the same tax outcome. Income stacks. Again, ordinary income first, and that includes short-term capital gains. Then we have the capital gains stack on top of the ordinary income. That's qualified dividends. That's long-term capital gains. For example, many of you hold Vanguard Total Stock Market Index, Vanguard 500 Index. If you hold that in a brokerage account, most of that's going to be qualified dividends. There's going to be a little bit of non-qualified, like over 90% is qualified. So that's going to get the long-term treatment, the preferential treatment. And that's where we're talking about asset location a little bit later on. That's where it can matter tax-wise. Character matters and the buckets matter, the different tax treatments. Question for you as we go through this course, and this could be a rhetorical question, or if people want to answer, this can help unfold the course as well a little bit. What's your biggest tax concern? Or Or what's maybe a question that you had coming in? Yeah.
I think my biggest concern was the example you had. Life event requires money you didn't plan on drawing out and paying tax.
Okay.
I'm still struggling to find the best answer for that.
So the question was the unexpected expense example. How do we best plan for that? One analogy to use there is how do we plan for not when, but if the market's going to go down, right? Let's say I'm 70% stocks, 30% bonds and cash. I know the market's going to go down at some point. I don't know when. And I know how much of safe spending is going to be on that. But do I have enough in short-term reserves, cash reserves? That could be short-term government bonds, that could be short-term corporate bonds, that could be money markets, that could be CDs, something that is low volatile. And then when the markets go down or I have an unexpected expense, that gives me a little bit of flexibility. Depending on what buckets I have in terms of the unexpected expense is going to be a big factor. And what other income I have maybe turned on that I can't turn off is another factor. So kind of taking that, basically putting the big puzzle together of here's the income I already have, if I already have pension and Social Security turned on, and here's my portfolio mix. If an unexpected expense were to happen of $10,000 or $50,000 or $100,000, what options are available to me? And to go through that exercise ahead of time is going to provide dividends for when it happens. Because the reality of it, just like the market's going to go down, we don't know when, that unexpected expense is going to happen. We don't know how big, but it's going to happen. I know I didn't probably directly answer your question, but without. Yes.
The concern from an online user is when they start to receive their pension, plus when to receive Social Security.
So we'll be talking, that probably fits more the age windows that we'll talk about in session 4 of, because I think the question I heard was, I have collecting my pension, when do I turn on Social Security? So we're going to be talking about those different windows and the pros and cons in session 4 of when to turn on, when it might be to turn on different types of income depending on different portfolio mixes. So some of these I won't necessarily answer, but it will give me to make sure I answer them moving forward as well.
I think you mentioned you might cover my struggle right now is putting money away in tax accounts, lock that money up,
Perfect.
yeah.
Session 3. So the question was, I want to retire before I turn 59 and a half, and how do I access that money, which has been portrayed by the media as it's locked up? Okay. It's not locked up. We're going to be talking about different strategies in session 3. And there's a lot of different tools and strategies, so.
There's also the ACA to figure how you're gonna get health insurance before.
There's the health insurance before 65 question as well. And that depends on, does your employer provide health insurance, or do you have to go to the Affordable Care Act marketplace? Do you go private insurance? Most of us will go to the marketplace. And we'll be talking a little bit about how in the retirement windows in session 4 and how the health insurance and turning on different types of income affects that as well. Because you go over a little snippet, you go over $1, you all of a sudden lose potentially $15,000 to $20,000 in premium tax credit. So you got to really make sure you're knowing your numbers.
Focus right now. So currently still a traditional IRA. And I feel stuck in there, is there, because I was just, but I want, is there any way within the employer contribution IRA, to realize money in there that I can convert right now to Roth?
I'm gonna repeat the question, make sure I understand it. So you have your workplace retirement account has a lot of money, a pre-tax. Is there a way that I can convert that to Roth? So depending on the employer and what the SPD summary plan description allows, does it allow you to do a Roth conversion? And does that make sense in your tax bracket? And also, if you're over 55, some employers will allow you to take a portion out and put it in a traditional IRA, which then you can do a Roth conversion from there. Does that make sense? Others? Go ahead.
You talk about categorization of tax money, taxable, and then tax for your simply tax front. How do you categorize HSA money? How does that fit into a strategy for saving and avoiding taxes?
So he asked about pre-tax, he asked about the buckets, pre-tax, tax-free, and taxable. And where does HSA fit into that? We're going to dive more into that in next week's class when we talk about where to save, when to pay tax, and how that fits. And also we'll talk about it in session 3 on how it can be used to fund if we want to go before 59.5, or how do we use it in retirement. So as in your working years, early retirement, and retirement years, how do we use an HSA? So that will be talked about in those session 2 and 3. I think
What is the most tax efficient way for charitable giving before you turn to 70, 70.5, whatever, where there's a special rule there? But before that, I'd be interested in that.
Okay. I believe that would be in session 4, the tax windows.
Piggybacking off her question, with the marketplace insurance, what do they count all of your income, all of your savings, your pension, your, all that, and figuring out what just your earned income during the job?
So the question was, do they count for the Affordable Care Act, do they count all your income? And they use a modified adjusted gross income number. And that is that's a different number than what's used for IRMA. For example, the they use non-taxable Social Security income, they count that, versus for IRMA they do not. So essentially for the Affordable Care Act, everything that you can imagine is counted. Whereas for IRMA, the Medicare premium surcharge, non-taxable portion of Social Security is not counted. Yes. For what age? For under 65, 32,200. Couple over 65 would be 47,500. Yeah, for that, because of the One Big Beautiful Bill Act. She asked what the standard deduction was for a married couple. Under 65 is 32,200. Over 65 with under 150,000 of income is 47,500. When you add up the normal 65 plus deduction plus the One Big Beautiful Bill Act of 6,000 apiece.
a raw, so that you can eventually be, have some more money to spend.
So we're going to be talking about Roth conversions in session 3, kind of helping to go through a framework, a process of how to look at it, because it's more than just a math problem. And unfortunately, a lot of the videos out there have a lot of fear in them on convert, 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 when, yeah.
So what would the standard deduction be if one married couple was over 65? You know,
So then one would get the 6,000 and you wouldn't get the other 6,000. Yes. So the first question over here, I'm just going to repeat this for the live audience. First question was, if one person in a couple is 65 and one person 64, then you would get the single 6,000, one big beautiful bill act deduction. The second question was, if I go over the income threshold for a married couple filing jointly of 150,000, what does it decrease by again? It's a 6% rate. So 6 cents for every dollar, all the way up to, it phases out at $250,000. Okay. I'll be available. I'll stay a little bit after as well. Again, session 2 is going to be about when to pay, when to defer taxes.